Good evening. This is Doc Severson for the Theo Night Report for Tuesday, June 19th. What I've got to start out with here tonight is a tick chart of the ES futures or the S&P 500. And you can see where things kind of closed yesterday in yesterday's session right around here. And then in the evening yesterday, we started to get pelted. And this is all based on Trade Wars Part 13, apparently. And so we bottomed out as the European session opened, and then from there the dip was being bought. Now you will notice that the gap was not filled. That would be an enormous hammer candlestick if that were to happen on the S&P futures for the day, but we did not get that. Now let's move over to the monthly, weekly, and daily charts because we're starting to see some interesting patterns as we look at the different indices. Now, a couple of weeks ago, I talked about the haves versus the have-nots, and that spread is getting worse and worse. And actually, this is starting to become a little bit of a concern when it comes to the market. So we all know that we've been in this consolidation pattern since the beginning of February, and it looks like, especially in the S&P and some of the other indices, like it's breaking out to the upside. Okay, so it looks like we're changing character state from a consolidation or a corrective pattern back into accumulation phase with a quiet and trending rally to the upside. So quiet and trending is one of the major forms of price character and generally is associated with the price kind of doing this sort of thing. Breakout, consolidation, kind of Groundhog Day all over again. And this is what we saw through much of 2017 was a sort of Groundhog Day price action where we get the breakout, consolidation, until we got the final parabolic tail. Okay, so the assumption is over the last 5 weeks since we've gone into this type of price behavior is that we're moving back into that quiet and trending. However, I do want to bring up a couple of cases here. We always want to make sure that we're not being influenced by our bias because bias means that you put a lens in your glasses that makes it unable for you to see what's actually happening to the price. You're looking for confirmation of your bias, which gives you confirmation bias, so you literally cannot see something that's happening in front of you. So what I want to bring to your attention is something that if it happens, this would be a devastating signal, especially for the S&P 500. It may already be starting for the Dow right now and all the various components of that. So I'm going to zoom in on this period right there. Okay, so we're seeing this little rally that we've had really since the end of April, beginning of May, right? So we put in a strong bottom, strong rally, consolidation, slingshot movement to the upside. And these blue lines that you're seeing are the expected move for the week. Now, this weekend, when I saw these lines, I saw this level of support. So former resistance at 274 or 2740 becomes new support as the price breaks above it. It's testing it from above. This is a very common garden variety type of retest of a breakout level. And it's also in confluence with the weekly expected move of the S&P 500. So one of the trades that I took today was, in effect, to that point, was the fade off the expected move bounce. So here's the thing. With today's movement, and even though a day like today, when you see a green candle like this, it's almost like you've won the battle, but you've lost the war kind of thing, because this is actually a pretty strong gap to the downside. But I think everybody is just assuming that the price is going to bounce back up again, much like the price bounced off of this very important support level just weeks ago. Okay, so everybody is leaning to the upside right now. Everybody's leaning to the upside right now. And this is why we might be on tap for one of what I consider to be one of the most devastating signals in charts, which is called the lower high. The lower high occurs when everybody gets caught leaning to the long side and the price does rally up, but to a lower high, and everybody becomes absolutely complacent. So they let down their guard because they just assume that prices will rally higher. This is typically when something hits the tape, some catalyst hits the tape that nobody is expecting, and we print not only a lower high, but also a lower low, and this is where the selling really hits the tape. So if I expand this out on the S&P 500, if we go back to 2011, the summer of 2011, we can see a great example of this lower high. So we kind of had this wandering pattern, and in retrospect, it was actually a head and shoulders pattern that set up. But the devastating signal that was created back here in July, so this is late July and then into early August, as we had a bounce here and the price started to rally from this level, everybody absolutely let their guard down, and all of a sudden it's almost like nobody saw this one coming. And then of course the news started to really hit the tape, and it was about Europe. And of course that was right around the time that the Standard & Poor's company decided to downgrade the United States debt on a Friday afternoon after the market had closed, where nobody could do anything about it. And so this is why we had this kind of selling climax at the very bottom here. But the lower high, again, I want to reemphasize the fact that the lower high occurs, and it's a wicked technical signal because nobody is looking for it. When the price starts to bounce, everybody lets down their guard and just assumes that the bounce is going to continue. And then nobody knows what to do when the price undercuts the low and all of a sudden the real selling hits the tape. Nobody's prepared for it, so everybody's caught back on their heels. Now, the S&P is actually in much better shape than the Dow. Of course, the Dow is being hit much more by these trade wars because of the multinational components that they have, which are going to be hit by tariffs pretty hard. And so you can see the two main drivers of the Dow right now, which is Boeing and Caterpillar, both had a terrible day. And if we look back over the Dow, we're still seeing the same rally from the lows, but you have to look at this and say that this is not very strong at all. In fact, what I would more classify this rally that's coming off of the lows is this is more of a bear flag than anything else. So today was not even a green candle right on the Dow, so we gapped much lower and barely was able to recover half of what was dropped over the day. And we're starting to see, as a result of the Dow, or as part of the Dow's drop, again, like Boeing is definitely dropping off of the highs and is in trouble of any high that's printed here, of printing a lower high. And actually Caterpillar is worse because Caterpillar looks to have already placed a lower high and then a lower low already. So Caterpillar's in trouble, Boeing is in trouble right now, and I'd say the Dow is in trouble for potentially setting up a bear flag. So let's go back to the Dow chart again one more time. Again, take a look at this. Again, we have a fairly defined neckline for this. Again, everybody is thinking that it's just going to bounce higher from here, and it may not. So let's watch this neckline really carefully over the next few days, because this could really set the tone for the market. Now, the odd thing here, I guess not really that odd, because if we look at the Russell is absolutely impervious to all this, because it's over here saying, hey guys, I really don't care about the tariffs because all of my businesses are domestic. So do what you want to with these tariffs. And it's taken all of this consolidation and all of this energy that's just been coiling up in the Russell for months and has broken out very strongly to the upside. So this is about a 150-point move, and on the Russell, that's massive. That is a massive move, and it's still chugging higher. Although, keep in mind, weekly exhaustion here. There's a limit to how far this is going to go in the short term. So please don't chase after this one at this point. This one needs some serious consolidation. I'm going to finish up this video by going back to the spiders. And again, what I mentioned is that when we have these expected moves for the week, and as of late, the expected move has been honored on a weekly basis, all the way through the consolidation pattern here, the big weekly pattern that we had, the expected move was just completely abused and blown through on a regular basis, week to week. But as we've moved into quiet and trending, we have seen the price respect the weekly expected move. And so this became a fade. Either one of these became a fade, whether it tried to break above the upside one or tried to break down below the downside expected move for the week. So it chose the latter, and today I set up a fade into that. So the best tool for this job is just simply an at-the-money vertical call spread, or what we call an in-out spread. So one option in the money, one option out of the money, looking for about a 1-to-1 reward to risk on the trade. And so we were able to set up this trade. It's $2 widespread for just a little bit less than $1. So our target on this is going to be about 55%. I'm expecting that to hit tomorrow as long as we don't see a big drop in price to retest that level from above again. So the expiration is front week, so I have until this Friday for the trade to place, but any upside movement whatsoever will fire off the limit order for this trade tomorrow. So folks, keep your eyes peeled for the Dow. Watch out for Boeing. Watch out for Caterpillar. Watch that neckline on the Dow and see if that breaks. Watch the S&P and see if the S&P prints a lower high. If it prints a lower high and starts to drop from there, then we may have an interesting summer on our hands. That is it for today's report. Thanks for listening. We'll see you tomorrow.